Welcome to Invest Like Bogle. Today we're diving into a truth that separates the gamblers from the genuine investors. If you hold the stock market, you will grow with America. Think about that for a moment. You don't need to outsmart Wall Street, chase hot stocks, or predict the next crash. You simply need to own the market itself, because when you hold the entire engine of American enterprise, every factory, every invention, every innovation, you're not betting on luck, you're betting on progress. This is the kind of wisdom that sounds almost too simple to be true, yet it's built more wealth than all the market forecasts and trading strategies combined. While others panic, you stay calm. While they speculate, you accumulate. While they chase noise, you capture growth. And that's the secret the financial world rarely tells you. Real investing isn't about excitement, it's about ownership. So today, we're going to break down why holding the market means growing with America, how discipline beats drama, patience beats prediction, and how the quiet investor who simply stays the course often ends up miles ahead of the crowd. This isn't just investing advice, it's a philosophy, one that's turned ordinary people into extraordinary success stories. Stay with me, because by the end of this video, you'll understand why the most powerful wealth-building move you can make isn't to find the next big thing. It's to own everything and let time compounding in America's unstoppable growth do the rest. You don't need genius to win in investing. What you need is sense, the kind that keeps you grounded when others are running wild. The stock market, in its essence, is not a casino table or a scoreboard flashing numbers. It's a reflection of American enterprise itself, the collective effort of millions of workers, engineers, entrepreneurs, and thinkers who wake up every day to create value. Over time, that work adds up. It shows up as profits, dividends, and innovation. And if you simply own a piece of that engine, patiently, you get to ride along with it. That's what real investing is, not guessing, not chasing, but owning. The market is, and always has been, a relentless compounding machine. The problem is that most people never stay long enough to let it work. They jump in when it's hot and bail out when it's cold. They believe that somewhere out there, someone has a crystal ball that can predict which stock will soar next or which manager will dance around the downturn, but no one knows. No one. The only sure way to capture the return of American business is to own it, all of it, and hold on through thick and thin. When you own the entire market, you don't have to pick winners. The winners are already in there quietly pulling your future forward. Think about what drives those returns. It's not magic. It's the sweat of builders, the risk of innovators, and the productivity of workers. Over decades, that combination has made this economy one of the strongest on earth. The companies that make up the market are not static. They evolve, they compete, they fail and rise again. Some vanish, new ones take their place. Yet through all that churn, the market as a whole grows because the human spirit to build and create never stops. When you invest broadly, you tie your fortunes to that enduring force. You stop betting on individuals and start trusting in the collective power of enterprise itself. That's what being sensible means. It means accepting that you can't control markets, but you can control your behavior. It means understanding that the path to wealth is not paved with forecasts or fancy charts, but with patience and simplicity. Most investors lose not because they choose bad stocks, but because they can't resist the urge to act, to do something when doing nothing is the smartest move. The market rewards discipline. It punishes emotion. When fear dominates the news, prices fall. When greed takes over, prices rise too far. But over time, both fear and greed fade, and what remains is the steady upward push of productivity and profit. If you're holding the market, every advance in technology, every improvement in efficiency, every bold new idea contributes to your growth. You benefit from the sum of human progress, not from one man's hunch. It's a slow, sometimes dull process, but it's unstoppable when you stay the course. The great paradox of investing is that the less you do, the more you make. Each trade, each switch, each hot tip chips away at your future. But if you buy the market, reinvest your dividends, and give it time, the compounding does the heavy lifting for you. Think of owning the market as owning America's future. It's a bet on innovation, on resilience, and on the belief that despite the noise, progress continues. There will be recessions, crashes, crises, and recoveries. Always have been, always will be. Yet through every storm, the market has found its way forward because the people behind it never stop creating. The economy, like the country itself, is built to endure. So the sensible investor does not panic in downturns or chase the latest fads. They simply own the market, stay patient, and let time, the greatest ally of compounding, do its work. In the end, the truth is simple. The stock market is a mirror of human effort and ambition. When you hold it, you hold the engine of progress itself. You don't have to predict, outperform, or outguess. Just own it and let America work for you, as it always has for those who stayed the course. Costs are the silent killers of investment returns. They creep in quietly, take a little here and a little there, and over time they devour a staggering portion of your wealth. You may not notice them day to day, but over the years their effect compounds, and not in your favor. Every percentage point you pay in management fees, trading commissions, or taxes is money that's no longer working for you. It's gone permanently. And once you understand how powerful compounding is, you realize how devastating it can be when it works against you instead of for you. Let's be clear, this isn't a theory or a philosophy, it's simple arithmetic. If the market returns 8% and you lose 2% to various costs, you don't just earn 6%, you lose the compounding effect on that missing 2% every single year. Over a lifetime of investing, that small gap can easily mean hundreds of thousands of dollars in lost wealth. Investors often underestimate this because costs seem so small in isolation. A 1% management fee sounds harmless, almost trivial, but over 30 or 40 years, it can consume nearly a third of your total potential return. That's not an exaggeration, that's math. The tragedy is that most investors never see these costs clearly. They're buried in fine print, wrapped in jargon, or disguised by promises of professional management. You'll hear phrases like expert strategy, research-driven performance, or dynamic allocation. Behind those words, more often than not, is a price tag that you pay whether you win or lose. And when you lose, you still pay. The managers get their fee, you get what's left. That's not investing, that's feeding a system that grows rich on your money while claiming to serve your interests. Here's the truth that too few want to admit. Markets are unpredictable, but costs are guaranteed. You can't control what stocks or the economy will do, but you can control what you pay. Every dollar you avoid spending on unnecessary management commissions and speculation stays in your pocket where it belongs. Over decades, those saved dollars earn returns of their own, and those returns earn returns again. It's the simplest, most certain way to improve your investment outcome. The low-cost investor doesn't just save money, they gain freedom. They stop worrying about whether their fund manager will outperform because they're not trying to beat the market, they're trying to capture as much of it as possible. When you minimize costs, you maximize your share of the market's return. It's that simple. No genius required, no prediction, no secret formula, just the quiet discipline of refusing to pay more than you have to. And let's talk about trading, because that's another form of cost too often ignored. Every time you trade, you pay, sometimes visibly in commissions, sometimes invisibly through spreads and taxes. Frequent trading is the enemy of compounding. It tempts you to act on emotion and illusion, the illusion that you can outguess the market or time its next move. The result is usually the same. You transfer a little more of your return to someone else. The market may rise and fall, but costs are constant. They take their slice regardless. When you strip investing to its essence, you find two forces at work: what the market gives and what you get to keep after costs. The difference between those two determines your future. The investor who keeps costs low gives compounding a fair chance to do its magic. The investor who pays high fees is fighting a battle against arithmetic, and arithmetic always wins. It's not exciting advice, it won't make headlines, but it's the kind of truth that separates the investor who quietly grows wealthy from the one who spends a lifetime chasing performance and coming up short. The path to better results isn't paved with cleverness or complexity. It's paved with thrift, discipline, and respect for the power of small numbers over long periods. So every time you look at an investment, ask one question before anything else. What does it cost? Because that question, more than any forecast or fancy analysis, will tell you how much of your future you get to keep. In the end, the market will do what it does: rise, fall, and rise again. But costs are forever. And the investor who keeps them low wins not by luck, but by logic. The biggest threat to your investment success isn't the economy, the Federal Reserve, or even the next market crash. It's you. Human nature is the greatest enemy of long-term returns. We are emotional creatures wired to react. When markets rise, greed whispers that we're missing out. When they fall, fear screams that we must get out. Both emotions push us to do the wrong thing at the wrong time. The truth is simple. The market's long-term return is generous, but it does not hand out rewards to those who can't sit still. Every great boom has been built on optimism that the good times will never end. Every crash has been fueled by despair that the world is collapsing. Both feelings have repeated for over a century, and both have led countless investors astray. You can trace every major market failure back to the same pattern. People chasing what's hot and fleeing what's cold, buying high, selling low. It's not intelligence that determines who prospers in investing. It's temperament. The market doesn't pay you for brilliance. It pays you for patience. There's an old saying that time in the market beats timing the market. It's true because the odds of guessing right twice when to get out and when to get back in are practically zero. Miss just a handful of the market's best days and your returns can be cut in half. The most successful investors aren't those who dodge every downturn. They're the ones who endure them without losing their nerve. They understand that volatility is not a threat, but the price of admission for long-term growth. The ups and downs are part of the journey, not a signal to abandon ship. The remedy is beautifully dull. Buy broadly, hold patiently, rebalance when necessary, and ignore the noise. That's it. You don't need to predict what will happen next quarter or next year. You don't need to watch the markets every day or analyze every headline. You just need the courage to do nothing when everyone else is losing their heads. Boring? Absolutely. But boring is powerful. The discipline to stay calm while others panic is the rarest and most valuable trait an investor can have. It's easy to underestimate how destructive behavior can be. Studies have shown that investors in the same mutual funds often earn less than the funds themselves. Not because the funds perform poorly, but because investors jump in and out at the wrong times. They buy after strong performance, convinced the good times will continue, and they sell after declines, fearing things will only get worse. In the end, they turn a winning strategy into a losing one through emotion alone. The market rewards conviction, not confusion. That's why owning a broad, low-cost investment and sticking with it through every cycle has been the quiet secret behind many fortunes. You don't have to outsmart the market, you just have to outlast your own impulses. The investors who succeed aren't the ones glued to financial news or chasing every new product. They're the ones who make a plan, once set it in motion, and refuse to let noise distract them. They understand that investing is like planting a tree. The shade you'll enjoy later depends on how long you let it grow undisturbed. The great irony is that the more we try to control the market, the less control we actually have. The market doesn't care about our opinions, emotions, or predictions. It moves on its own schedule. But what we can control, and what makes all the difference, is our reaction. The investor who resists panic in a crash and resists greed in a boom will quietly outperform the restless crowd over time. So if you want to win, do less. Buy a piece of the whole market. Keep your costs low. Rebalance when your allocation drifts too far. And then, most importantly, leave it alone. Don't let the daily noise shake your faith in long-term compounding. The market's history has always favored those who had the courage to be patient. Stay the course, because behavior, not brilliance, determines who reaps the reward. In investing, as in life, incentives shape behavior. If you want to understand how an organization or a manager will act, look at how they get paid. The structure always tells the truth. When someone is rewarded for gathering assets, they will focus on collecting more money. When they're rewarded for short-term performance, they'll take more risk to chase short-term gains. But when their success depends on your success, when they win only when you win, that's when trust and fairness begin to align. The right structure creates honesty. The wrong structure breeds exploitation. Too many investors hand over their savings without asking the simplest question: whose side are you on? They assume the manager's interests naturally align with theirs, but in much of the financial world, that's simply not the case. The industry is often designed to serve itself first and its clients second. High management fees, short-term trading, and performance bonuses all sound sophisticated, but they create powerful incentives that encourage activity, not results. The more a manager trades or sells, the more they earn. Meanwhile, you, the investor, bear the cost. That's not partnership, that's extraction. Real alignment begins when the investor is treated as the owner, not the customer. Ownership changes everything. When the people managing your money are not middlemen but stewards, when their job is to serve the long-term interests of the shareholders, not to enrich themselves at the shareholders' expense, then the relationship becomes what it should be, a shared journey toward mutual prosperity. The investor gets a fair return. The manager earns a fair wage for honest work. No hidden fees, no double talk, no conflicts disguised as innovation. The ideal investment structure is one that minimizes the friction between you and the market's return. Every extra layer between your capital and its productive purpose creates room for self-interest to sneak in. Brokerage commissions, marketing budgets, executive bonuses, they all come from somewhere. And that somewhere is your return. The lower those costs and conflicts, the more of the market's natural growth you keep. The system should work for the investor, not the other way around. When incentives are misaligned, the results are predictable. Managers become focused on appearances, quarterly performance reports, media attention, and asset growth rather than genuine sustainable results. They start selling stories instead of stewardship. But the market doesn't reward stories for long, it rewards discipline and time. The manager who chases applause will eventually chase returns, and that pursuit almost always ends in disappointment. The manager who treats your money as their own, on the other hand, will act with the caution, prudence, and patience that true ownership demands. It comes down to a simple but powerful truth. You can't serve two masters. A fund manager cannot serve both shareholders and shareholders' wallets equally. One must come first. If the structure favors the firm through high fees, incentives for asset gathering, or layers of marketing, the investor will always come second. But if the structure is designed so that the firm's prosperity depends directly on delivering value to the investor, then both can grow together. That is the essence of fairness. You deserve a system where trust isn't something you hope for. It's something built into the design. Transparency, simplicity, and shared interest should be the foundation. If you can't understand how your money is being handled, or if the compensation system is too complicated to explain in a sentence, something's wrong. The best investment organizations are boring in the best possible way, efficient, predictable, and focused on the long term. So when you choose where to place your savings, don't be dazzled by slick presentations or grand promises. Ask one question that cuts through the noise. Are our incentives the same? Because if they're not, you'll always be the one paying the price. A structure that rewards integrity will protect you even when the market doesn't. But a structure that rewards greed will betray you, no matter how good it looks today. When incentives align, everyone rows in the same direction. You get what you deserve, a fair share of the market's return. And the people managing your money earn what they deserve, the trust and respect that come from serving others before themselves. That's how investing should work, not as a game of taking, but as a partnership built on shared success. So what should you do tomorrow? Very simply, spend less than you earn. That is the foundation. Place your savings into broadly diversified, low-cost funds that represent the whole market. Let them do the work. Ignore the daily noise of returns and the pundits who promise shortcuts. Shortcuts are expensive. Rebalance at sensible intervals to keep your risk in line with your goals. Remember that time is the investor's friend. When you own the market for the long run, compound does heavy lifting for you. I once met an investor who spent a lifetime trying to outsmart the market. He switched managers, paid high fees, and reacted to every quarterly report. He ended up with less than a friend who did three things: saved steadily, owned a broad market fund, and stayed the course. The investor who chose simplicity won not because he was cleverer, but because he was consistent. This is not a sales pitch for any single product. It is a plea for common sense. The path to shared prosperity is not lined with secret formulas. It is paved with discipline, low cost, and patience. If you hold the stock market, you do something far more powerful than gamble. You become an owner of the American enterprise. You join millions of workers, entrepreneurs, and inventors whose labor and creativity create the returns that investors share. Be an owner, not a speculator. Keep your costs low, your horizon long, and your head steady. Over time, if you hold the market, you will grow with America. Thank you. Now go home, check your fees, simplify your plan, and let time do the rest.